Good afternoon, everyone. My name is Brenden Healy. I have the honor of speaking with you this afternoon to talk about the Connecticut pass-through entity tax changes. Um, Looking forward to this discussion, and one of my associates, Margie Craig, will be joining me behind the scenes. She's running the slides for me, so thank you to Margie for doing that for me. This discussion is it's going to start off basic. Some of you may be familiar with Connecticut's pass-through entity tax rules. It was enacted in 2018. We'll go over that in a second. So we're going to provide a little bit of history of this to kind of set up and tee up this discussion, and then we'll move into the recent changes to this tax. So with that, Margie, you want to go to the next slide? So my name is Brenden Healy. Just so to introduce myself, I'm a tax partner with the accounting firm Whittlesey here in Hartford. And my practice runs the gamut from nonprofits to closely held businesses, family-owned businesses, manufacturers, retail, real estate, manufacturing, distribution, things like that. So a lot of our clients deal with the pass-through entity tax. Again, looking forward to talking to you about it. And just to point out the message from the CBIA, please use the chat for questions. Would love for this to be an interactive discussion if you do have questions. And as I mentioned to my CBIA friends, if the question gets very detailed or granular, so to speak, we may pull it offline and we can have a follow-up discussion. But feel free to ask questions and provide commentary as well. So let's get into it. So the pass-through entity tax. So here's a brief history. So back in the end of 2017, Congress and President Trump negotiated and changed a bunch of the tax rules. One of those rules was the SALT deduction, the state and local income tax deduction. What does that mean? It means that when you and I pay our Connecticut income taxes, and if we itemize our deductions on our federal income tax return, we get to take a deduction. We used to take a full deduction, but now we're limited. But we take a deduction for the taxes we pay on our house, on our cars, the property taxes, and we would also take a deduction for the taxes we paid to the state of Connecticut, our state income taxes. So under the relatively new tax rules, Congress said, okay, we don't care how much you pay in property taxes, car taxes, state income taxes, add those all up, but we're only going to allow you to deduct $10,000. That's it. You can't deduct any more on your as a federal itemized deduction. And so that limited a lot of folks in Connecticut. If you think of two income families, you think of a house, car taxes, there's a lot of taxpayers that hit that cap very quickly, and especially a business owner who of a pass-through entity where the profits of the business end up being taxed on the owner's tax returns. Their state and local tax cost and their state and local tax expense is very big. So as a result of this federal change, Connecticut and other states, but Connecticut, I give the legislature credit, they were quick to react and say, okay, well, they actually had two scenarios, if you will. They had one for charitable contributions and property taxes, which we're not even going to talk about, and that didn't fly. But this one that leads into the Connecticut pass-through entity tax was a change that said, okay, we're gonna change how Connecticut taxes its pass-through entity owners. We're gonna convert the personal income tax, in a sense, to a business tax. So my last bullet point here, there's no federal limit on business state income taxes. So if I'm trying to deduct my state income taxes on my tax return, there's a limit. But if I have a rental property and I'm deducting those taxes, or I have some other business related taxes, there's no limit on the business related taxes. So what Connecticut did was they said, okay, we're going to impose a business level tax on these pass-through entities, and we'll force the entities to pay this tax which they then can get a federal deduction on their tax returns. So they're getting the deduction as a business deduction. And then in order to avoid the double tax to both the business and the owner, we're going to give the owners a credit against their Connecticut income tax. So thus one level of tax. So they came up with this pass-through entity tax. I'll call it a scheme, but I don't mean that in a negative way. It's just a system, and it was designed to circumvent this limit on the SALT taxes. Margie, if you go to the next slide. So the Connecticut PET, pass-through entity tax, applies to partnerships, S corporations, and limited liability companies that are taxed as partnerships and S corporations. It's very important to note that it does not apply to single member LLCs. So if you have a one owner of a company, they don't get to benefit from this system, so to speak. It doesn't apply to regular corporations. We call them C corporations and publicly traded partnerships. And it just applies to partnerships and S corporations and then LLCs that are essentially taxed like that. Interesting fact, Connecticut was the only state to impose a mandatory pass-through entity tax. Other states implemented certain similar type structures, but Connecticut was the only one that had a mandatory one. But prior to 2018, and so this was a result of the late 2017 tax law changes, which federally that took effect in 2018. So Connecticut reacted relatively quickly in 18 to implement this. But prior to 2018, Connecticut had something called a composite filing requirement, which is different, but I want to go over that because that's going to lead into the changes. Can you hop to the next slide? So I'm going to use an example throughout this presentation, and I'm going to pretend we have a manufacturer, and I'm going to pretend it's an LLC and it's taxed as a partnership, which is the default classification. And I'm going to pretend it makes auto parts here in Connecticut and also sells them here in Connecticut to people that want to buy auto parts, fix their cars. But they also sell online throughout the United States. So whether it's Amazon or something like that, but they sell over the internet. So they only have a physical location here in Connecticut. And all their employees who are here in Connecticut, and on its tax return, there's a couple of items of income. So the company has income or loss. Let's pretend they have a profit. So the company has a profit from selling its products here in Connecticut. And let's also pretend, because it's done so well in the past, they have money in the bank, they have investments, and they're earning interest and dividend income from their investments. So when the owners have when the income is passed out to the owners at tax time, they would have to report both the business income as well as some interest and dividend income passed through to them. And then let's pretend this business is owned by two people, someone from Massachusetts, a Massachusetts resident, that's important, and then a Connecticut resident. So that's my fictitious company. We're gonna refer to that throughout this presentation. But prior to this pass-through entity tax system, Connecticut would say, hey, manufacturing business, you're earning profits here in Connecticut. Forget the online sales for a second. You're earning profits here in Connecticut, and the Massachusetts owner lives in Massachusetts, presumably files a Massachusetts income tax return, pays tax in Massachusetts, but they also owe Connecticut some income tax based on their share of the Connecticut income that's earned here in Connecticut. So we don't trust out-of-state owners to file Connecticut income tax returns and pay their taxes. So because we don't trust them, we, in lots of other states have done this, but we here in Connecticut are going to require the business to pay in those taxes for the non-resident. Connecticut doesn't want to go chasing down taxes out of state residents or from out of state residents. So they have the system, the composite filing system, so to speak, where it said back in prior to 2018, it said an entity could file a tax return on behalf of a resident, take care of the filing. That way the resident doesn't have to worry about filing, and that way Connecticut gets its taxes. So I don't want to dwell on that, but I just want to kind of plant that seed as we talk about the history and then ultimately the changes. Margie, could you go to the next slide? So a couple other points on this pass-through entity tax. If I'm a partner in a partnership or an LLC taxed as a partnership, not only will I have my share of the income or loss allocated to me in my Schedule K1, which is kind of like a 1099, it's just a form that allocates the income, but my salary, which is not salary, it's called a guaranteed payment. My guaranteed payment is also allocated to me on my Schedule K1 as a flow-through item. So just just some facts for your knowledge. Early on, this pass-through entity tax only applied to essentially the operational income, the profit loss from the business operations. Not necessarily, it did not apply to the guaranteed payments that were allocated to the partners. That changed in 2019, where they said, no, you should include the guaranteed payments as part of this taxing system. A couple other points here. Connecticut said, hey, if the entity owes less than $1,000, you don't need to make these payments. You don't need to make estimated payments. You would still file a return and true up with us at the end of the year, but $1,000 or less, you don't have to make an estimated payment throughout the year. And then, so I talked about this earlier, the owners would get a Connecticut income tax credit for their personal returns, such that under the pass-through entity tax system, the entity is taxed on its income for Connecticut purposes. It then takes and gets a federal deduction for its Connecticut taxes, but then it passed out a credit to the owner so that the owner, in theory, is not double taxed on the income. So if the entity is paying this Connecticut state tax on the profits, why should the owner do it too? You shouldn't have it taxed twice. The original credit was, I think, 93% and change. Connecticut reduced it to 87.5%. What does that mean? That just means, okay, for every dollar of tax that's paid by the business, 87.5 cents of that becomes a credit on the owner's personal tax return, or for their personal Connecticut tax return. Why is that important? It's important because the owners, even though the entity is paying the tax, because this credit is not dollar for dollar, it's not really paying the tax on all the income. It's paying the tax on a lot of it, but not everything. So a brief example of that is if all I had was a pass-through entity that operates in Connecticut, and that's my only income, my only source of income, and the entity pays its tax on its profits, then passes out to me the credit, it's possible, not always, but it's possible that I would still owe tax on the company income for that difference between 100% credit and the 87.5% credit. So it used to be a higher credit, I believe, I don't know this, but I believe for legislative and budgetary balancing purposes, I believe they reduced the credit to 87.5%, essentially to have a kind of a stealth tax, if you will, on the business owners. All that being said, this is still a good system for Connecticut pass-through entity owners. This is generally a more favorable way, especially with the tax rules where they are today. The tax rules that I talked about earlier, the state and local tax, the SALT deduction, that's scheduled to expire in a few years, because those changes were only they were temporary changes. But for the near future, I think 2026 it expires. So for the near future, this system still works. It's a great system. And then one last thing for tax practitioners that might be on the call, we know this, but the business owner may not know this. even though we lost that SALT deduction with the federal tax changes in 2017, 2018, even though we lost that deduction, a lot of times we never really had that deduction. We think we did, but there's something called the alternative minimum tax, which is very complicated. Don't want to get into it on this webinar, but there was something that alternative minimum tax often offset the benefit we got from the state and local tax deduction. Nobody wants to talk about that. We want to talk about, hey, we lost that deduction, and hey, Connecticut, thank you for this pass-through entity tax. And the reason why I bring all that up is just to say that although I'm generally not in favor of new business taxes, this is kind of one new business tax back in 2018 that was beneficial to the business owners because of the way they changed it. Can you go to the next slide, Margie? Okay, so just a couple other historical things. So prior to 2018, Connecticut allowed that composite tax return filing, where Connecticut said where the pass-through entity could file on behalf of the Massachusetts owner in my example. Then for 2018, they eliminated it. Then for 2019, they changed it back and said, okay, the pass-through entity can elect to file this composite filing on behalf of the non-resident individual members, in my example, the Massachusetts owner, if they want to. And it's essentially a company level filing that it's in lieu of the owner filing its own Connecticut personal income tax. And then my last bullet point, if the pass-through entity elects to do that composite income tax return, the non-resident owner, the Massachusetts person in my example, has no, as long as they're paying the tax, they have no responsibility to file a Connecticut income tax return, assuming that all their income is from the electing pass-through entity. Next slide, Margie. Really quick, when the pass-through entity was first introduced, they kind of passed the rule during 2018. So there was really no estimated tax requirement. They then updated that and said, okay, we want you to pay quarterly estimates just like you would as an individual. Let's have the entity do it. And you got to pay, just like folks do, April, June, September, January. So if you owe less than $1,000, you don't have to pay estimated taxes during the year. You still have to file a return and true up the tax, but and then there's an annualized installment method if you want to do, but we can talk about that later if someone has a question. So next slide, Margie. Okay, so we have this fancy new pass-through entity tax system. It's a way to circumvent the IRS limitation, or I should say Congress's limitation, but the IRS limitation on itemized deductions. Okay, great. Well, how do we calculate this thing? So Connecticut said, okay, we're gonna have two methods, if you will. We can either use a standard base, which is the default method, which was the default method. It changed, but the standard base was the default method. Hey, everyone uses this unless you elect this alternative base method. So standard base, alternative base. That's important because the standard base goes away with these new changes, and we're only using the alternative base going forward. Well, let's just talk about this quickly. So the standard base still is in play for 2023. These changes take effect January 1, 24 and forward. So standard base, and this gets a little technical, but it's essentially look at all the income on the business tax return. So in my example, the manufacturing company, the LLC, okay, look at all the income that's on that tax return. Look at the income that's sourced to Connecticut, and essentially just tax all of it. Tax all of it. Send in the 6.9% tax, 6.99% tax, which is the highest Connecticut income tax rate. Send the tax in and thank you very much. Or you can elect this alternative based method, which says, okay, dig into it a little bit more in more detail, I should say, and dig through and look at the type of income, look at where it's sourced, look at a number of factors, and then pay the tax based on that, such that maybe you don't have to tax all of the income. Let's go to the next slide and we can talk about more. So the alternative base is equal to the modified Connecticut source income, which is essentially Connecticut sourced income, plus the resident portion of unsourced income. Meaning, all right, so let's take a step back. That's a kind of a complicated sentence, complicated bullet point. Back in our example, when we have a manufacturer that's selling to folks in Connecticut, that's Connecticut sourced income. They're making sales in Connecticut, that's Connecticut sourced. When the manufacturer, in my example, sells to someone in Michigan, let's say, over the internet, that probably becomes a Michigan sale. And I'm saying probably just because I'm talking like a tax person, but it's likely a Michigan sale, and it might get taxed by Michigan, but it might not. And that's a whole nother discussion about state tax nexus, but different states have different levels, different thresholds that you would tax the income allocated to their state. So said a different way, if my manufacturer has a lot of sales to Michigan, then my manufacturer likely would be paying tax to Michigan in addition to tax to Connecticut. But if my manufacturer only has a very little bit of sales to Michigan, then maybe no harm, no foul. Michigan doesn't want to tax that. So back to this alternative base, which is going to become the only one we can use in 24 and forward. So the alternative base is equal to the Connecticut modified source income, which is essentially income sourced to Connecticut, plus the resident portion of unsourced income, which is, as I say it there, it's income allocated to Connecticut residents that's not taxed in another state. What does that mean? That means if my sale to Michigan is not taxed in Michigan, and thus generating tax and a credit against my Connecticut income, if my sale to Michigan is not taxed in Michigan, my Connecticut resident will pay tax on that, even though it's a sale in Michigan. My Connecticut resident owner of my company will pay tax on that because Connecticut, like the federal government, Connecticut says, hey, if you're a Connecticut resident, we get to tax you on all of your income that you earned, no matter where you earn it. But oftentimes we'll give you a credit for taxes paid to another state. But in my example, it's because it's a little bit of sales to Michigan, they're not being taxed. So the Connecticut resident will end up paying Connecticut tax on that sale. So back to this first bullet point, the alternative base says, okay, look at my Connecticut sourced income plus add in the other income that wasn't taxed in another state as it relates to a Connecticut resident. So, you might be saying, that's not fair. Now you're forcing this company to pay a higher amount of tax. Well, yes, that's true, but the Connecticut resident owner is going to pay that tax anyways. Ultimately, they're going to pay that tax. Let's get it into this as a company level deduction. Let's get it at the company level. That way, the company gets a federal tax deduction on its own books. Let's get that deduction there. And then, so for federal purposes, the flow through is less than what it normally would be. And so ultimately, the Connecticut resident owner is winning, generally is winning on this. And so it's not the end of the world. So sticking with the alternative base, the second bullet point, the tax due under this method depends on the types of owners, essentially, that owns interest in the entity. So you got to look at it. That's a whole other discussion. And then the tax is 6.99%. I think I mentioned that the tax for this pass-through entity tax is the highest marginal rate. which is, I rounded to 7%, but technically it's 6.99%. I bring that up because Connecticut, you may not know this, but Connecticut has its own set of tax brackets. We don't really talk about it, but they exist. For federal purposes, there's tax brackets. As you earn more money, you get pushed, the incremental income, I should say, gets pushed into the higher bracket, it gets taxed, and then as you earn more, the additional income gets taxed higher. Connecticut's the same way. There's a 0% bracket. There's a 3%. There's different brackets, but the highest bracket is rounded to 7%, but it's 6.99%. All these, what we're talking about today, these pass-through entity taxes are taxed at the higher rate. Okay, next slide, Margie. Yeah, all right, so let's talk about the changes. So starting for tax years beginning January 1, 2024 and forward, we now have to file that composite tax return for a non-resident member for whom the business is the only source of Connecticut income. So back to my example, manufacturer has a Connecticut owner, a Massachusetts owner. In my example, if this was the Massachusetts owner's only Connecticut source income, the entity is now forced to file a composite tax return on behalf of the owner. So there's some more work involved. And we've got to make estimated payments on behalf of that non-resident owner. Next slide. Payments are they're still the highest marginal rate for the year, currently at 6.99%. That's my third bullet point. Any payment due with respect to each non-resident must be reduced by another credit. So sometimes we have tiered entities. Sometimes I own an LLC, call it a holding company that owns maybe an operating company and maybe multiple operating companies. So sometimes with these tiered entities, there's credits that are passed through. They're kind of passed up the chain, if you will, or down the chain, is however you look at it. But all this is, it's just clarifying that you've got to pay the tax, but you also take into account other credits reported by other entities. But in no event may the payment with respect to any non-resident shareholder be less than zero. So, essentially, you're not going to file a zero composite return for the non-resident. Next slide, Margie. However, so composite returns, which are personal income tax returns on behalf of the non-resident owner, the Massachusetts person in my example, a composite return is mandatory. Well, I should say a different way. The entity, the manufacturing company, will be mandated to file a composite income tax return for my Massachusetts owner if this is their only source of income in Connecticut. So they will be forced to do that. However, the pass-through entity tax, the pass-through entity tax, the PTET, is now elective. So the PTET could be optional, but the non-resident owner tax stuff is mandatory. And what's the concept behind that? Again, we don't trust the person living in Massachusetts, or sometimes you have lots of non-resident owners. Connecticut doesn't want to go chasing down taxes in different states. So if you have a non-resident owner, the entity may likely have to file a mandatory composite return for the owner, for the non-resident owner. So in my example, for the Connecticut owner, that's where we need to think about, does it make sense for the entity to pay in the tax for the Connecticut owner? Generally, I would say it probably does, because you're converting a otherwise non-deductible state income tax payment by the owner, you're converting that to a federal deductible expense in the business. That's generally how it works. But you've got to look at different circumstances. Does the owner have losses for other companies? There's just different scenarios that you've got to think through. So as a tax practitioner, and I think there's some on this call, I suspect there are, we've got to think about our clients. We got to think about we got to think through to the ultimate taxpayer. Does it make sense to elect into this taxing system? I'm saying it likely will make sense, but it's not going to every time. So going forward, the business entity, the manufacturing company, in my example, will opt in by submitting a written notice to the DRS annually. And it's likely, as part of the tax return filing. So, and then just as a reminder, we already know this, but the tax is generally due by the third month, the 15th day of the third month following the end of the year. If it's a calendar year taxpayer, the third month is March, so 15th day of March, March 15 is generally when these taxes are due. So that's really no change. Next slide, Margie. Okay. Yep. So in 2024, the standard base goes away. We have to think through. We have to use this alternative base. We have to use it. And if we're going to electing, just as a reminder, we've got to use the alternative base for all of the other passive entities. If I'm an owner, so if I elect into the passive entity tax, I got to think through. Maybe I own a real estate in a separate LLC. Maybe I own in another business, but they all have to line up. Yeah, and we talked about the alternative base pretty much. So next slide, Margie. Yeah, so previously, meaning prior to 2024, so 2023, we're still in, non-resident members were generally exempt from filing any type of Connecticut income tax if the passive entity tax credit covered their liability. But as we discussed, this new change forces the business to file a composite return, whether or not you elect into the passive entity tax system. Next slide. Yep, away. Same thing. We're mandatory composite tax return. I guess I really wanted to drill that into the presentation. Next slide, Margie. Okay, so here's a couple other things as part of the changes. Now, number one, under the new law, you don't pay in for corporate entities. So they've eliminated the corporate tax credit. Number two, we talked about the 87.5% credit. So for every dollar that the entity pays on tax on behalf of an owner, 87.5 cents of a credit is passed through. So the differential between 87.5 and 100% oftentimes creates a small tax for the owners. It may not, depending on their circumstance, but we see it a lot. We see the owner being a little bit shy. So I just want to remind everyone, even though we talk about the passive entity tax covering the taxes, it really doesn't cover all of it. So just keep that in mind as you think through your tax situation. The last bullet point is also important. Under the rules that we exist in right now, if I have multiple businesses, I can mush them all together. I can file essentially a combined pass-through entity tax return. Why is that important? Well, if I have income in one company but a loss in another company, I can file them together, mush them together, and they offset each other, lowers the total amount, or maybe even eliminates the tax that I would have to pay. Going forward, we can't do that. Each entity has to file by itself. We cannot combine them. So that's another reason why you may want to think through. So the owners may not want to pay in the passive entity tax if they have another business that's generating losses and they're allowed to deduct those losses. You may not want to elect into the passive entity tax. Next slide, Margie. All right, so here's a brief summary, and then we can get into questions if there are any questions. So the pass-through entity tax going forward, starting January 1, 2024, is now optional. Before we had to do it, now we can choose whether or not to do it. Probably still makes sense to do it based on what you're getting this federal deduction. Probably makes sense, but it's optional. The tax rate is still at the highest rate, so that's an important consideration because, as I mentioned before, Connecticut has tax brackets. We don't think about it, but they do. And so if the income allocated to the owner would be taxed at a lower rate, the entity is paying it at a higher rate, then the owner would have to file and get a refund. So you got to think that stuff through. We don't have to do this. There's no more corporate tax credit, reminding everyone. And then remind folks that the composite filing for non-resident owners is back, and it's mandatory. So even though the pass-through entity tax may be optional, if nothing else, we're adding some complexity to the tax filings for 2024, which will kick in, call it March 15 of 2025. So we still have time to think about this, but things are getting a little more complicated. Next slide, Margie, I think. Yeah, okay, yeah, the credit still exists. The 87.5% credit, that still exists. That hasn't gone away. Governor Lamont had proposed to get that credit from 87.5 up to 93.1%, essentially getting it closer to 100%, but legislature didn't do that. They left it at 87.5, which is still, again, it's still a win for the business owner, but it's not as big of a win. And then we can't combine returns with other entities, other commonly controlled entities, generally defined as 80% or more ownership. We can't combine. So we just got to think about that. Next slide, Margie. Okay, so we've got through the slides. So let's. I don't know if we have any questions. I just saw one pop up. Let me see if I think I can see it. Okay, I can see the question. All right, so Joshua asked a question. What action steps should we be taking from the session? And CBI responded, yeah, absolutely. So what should you be taking as a result of this? What steps should you be taking? Talk to your CPA, talk to your accountant. That's number one. If you don't have an accountant, you can look me up. Feel free to call me, but reach out to your accountant. The accountant likely knows that this occurred. But you want to start planning for it. Again, 2023 is under the same old rules, so to speak, but there may be some planning opportunities for you to think through for 2024. January 1st is right around the corner. So is there a way for, oh wait, let's look. Is there a way for a partnership to pass through an R&D credit or QREs generated by the partnership to the corporate partners? That is a whole nother discussion for Debbie. I would be glad to chat with you about that. That's a whole nother off-topic, hot and contentious issue within Connecticut. But yeah, let's follow up afterwards for that. Very good question. All right, another question. Businesses no longer have the option to file a combined return with commonly owned businesses. When is this applicable? For 24 and forward. So 23, you can still file combined, but 24 and forward, you cannot combine them together if the owner chooses the option to use the pet. So it's applicable whether or not you choose to elect into the pet. You cannot file combined going forward, period, the end. And then a second analysis or question is, should the owners choose to opt into the pet? But those are separate discussions. Another good question. What circumstances would you not recommend electing to pay Connecticut passive entity tax? Seems like the majority of the time it would make sense to pay. I agree. The majority of the time it likely makes sense to opt into the Connecticut pet. I agree. It's probably generally a true statement. But sometimes it doesn't make sense. If the entity doesn't have the cash, for instance, you may not want to opt in for you don't want the entity to get subject to a penalty or interest for not paying it enough. I see this when, hey, I've got a beautiful building that I sold. No, my clients don't tell me this. I get a phone call in December. Hey, Brenden, that great big building I had? Well, we sold it. We sold it back in August, and we got paid and we distributed all the money to the owners. So we have to file a tax return. Okay, great. But, today, hey, Connecticut is going to want those taxes. Now we got to go back and ask for the tax back from the owners to fund that tax, generally. But going forward, maybe it's a cash flow issue. Maybe the entity doesn't have the cash to do it. Maybe the owner, because of other things, maybe the owners may have losses or carry forward losses or something. So why pay the state of Connecticut tax if you don't have to? If ultimately there's going to be no tax when it's filed as part of the personal return, maybe that doesn't make sense. You want to look at state apportionment issues too, if you can, depending on how that plays out. So there's definitely reasons why you would not elect to do the passive entity tax. However, as a general rule, I would plan on electing it unless there's a reason not to. To clarify, this impacts companies headquartered in Connecticut with employees out of state and not companies headquartered in other states who have Connecticut employees. So, Deanna, good question. So I'll say it a different way. This impacts a pass-through entity that is doing business, quote unquote, doing business in Connecticut. So in my simple example, manufacturer had a place here, employees here. I made it simple. They're doing business in Connecticut. If they're from out of state, whether or not they're doing business in Connecticut gets a little more complicated. So maybe if they have employees here in Connecticut, but I don't think you do in your question. I'm sorry, you do. So maybe if there's employees here in Connecticut, that would trigger a requirement to file a Connecticut return. So really, to answer your question, Deanna, if I have to file a Connecticut pass-through entity tax return, then I'm subject to these rules. So it doesn't necessarily mean where I am headquartered. It's really, do I have to file a Connecticut return? And that can get complicated based on whether I have employees here or the level of sales I'm doing here and the nature of my business. So it could get a little question. Joshua, again, what questions should we ask our CPA to make sure we make the right decision for 2023 and 24? Great question, Josh. So again, 2023 we're still under the same rules. There's, pretty much we have to do it. So we continue to operate that way. But 2024, it's really I would focus on the ultimate owner. So all these we're talking about pass-through entities, which means the income flows out to the owners. Focus on the owners. What does their personal tax return look like? What are the components of that income? Are there losses? Are there suspended losses? Do we expect to have losses that would offset things? So it's really to answer that question, your CPA has to understand what the owners, the CPA has to understand what the owner's tax return is going to look like, i.e. do a projection. But what is the owner's tax return going to look like? And what are the components of that income to feed into that tax return? Said a different way, if the owner has profitable companies and is making money, it's likely you're just going to keep doing this and keep paying these pass-through entity taxes because they're benefiting the owner. But it's really when you have losses or maybe you have, well, if you have non-resident owners, things like that, but it's really focusing on the owner itself, and then kind of back into whether or not we want to do this. We got plenty of time. You're talking about filing a return for March of 2025, which would be the 24 tax year. So we have plenty of time. Another question. Your opinion is to elect to use the PET going forward, which uses the alternative tax base. Yes. So I'll qualify that. My opinion is that it's likely going to benefit the owners to elect into the pass-through entity tax going forward, even though they have to use the alternative base. Yes, that's my opinion. But that's just a general statement. You really have to look at the individual facts and circumstances to make sure that makes sense. But I suspect most of the time you'll continue, we the business owners will continue to opt into the pass-through entity tax. Josh, you're very welcome. All right. Are there any other questions? Okay. Okay, so we don't see any more questions, so I think I'll wrap up. Again, talk to your accountant, get in front of them. The more time they have to plan, the better, to think this through. If you don't have an accountant, call Brenden if you want, look me up. But get in front. Again, the more time we have, the better. So I'll say at this point, I'll say thank you to everybody. Thanks for your time. And wish you the best of luck in this complicated pass-through entity tax world we're in. Take care, everybody.